Hello. This is a debrief of the September-December 2022 SBR exam. You can find the exam on the ACCA practice platform. You will need to work through each question before you watch and listen to the debrief. Hi, we're going to be looking at the question Ruble, which has a year end 31st of December 2007. So 31st of December year end. First part of the question. Requirement. Two parts to the requirement and a nice big clue, I think, in there. So how should they treat the consignment arrangement? And explain why the proposed treatment is not in line with IFRS 15. Well, that's good news, isn't it? Because at least we know that what they're doing is wrong, so we have to think of something else. So that's going to help us make up our mind. We're not going to argue with that. And I can see already, if I look above here, Ruble is currently putting the sales value of all furniture delivered to the garden centres in revenue. So apparently that's going to be wrong when we read the scenario. First job then is to read the scenario. So if you need to, please pause the recording while you have a look through. Now, consignment is a term that means the same as, if this helps you, sale or return. You more normally see it in the motor car industry, where the manufacturer will pass the car to the dealer, and then the dealer can send the car back to the manufacturer again if they can't get rid of the car in certain circumstances. So it's that kind of contract, isn't it? We notice that there are all sorts of rights of return. If the garden centre, the retailer, cannot sell the furniture, they can actually sell it back. And also, Ruble again can ask for the furniture to come back. So it does sound very much, doesn't it, as if this is a situation where title is not passing until the garden centre, the retailer, sells the furniture onto the ultimate customer. We, again, in old-fashioned terms, we are retaining the risks and rewards of ownership at Ruble. So when we look at this, the points that I would have made are: how do we recognise revenue? Clearly, it's at a point in time. We're not offering any service. The usual phrase from our revenue recognition model is on transfer of control. Control is really when the garden centre sells the asset to the end customer. Until then, we have title to the goods. We can repossess the goods. You can see the points back down here. So essentially, that our responsibility. We can require them to send the furniture back. Again, so we keep legal title to the goods. That our goods, aren't they, till they're sold on to the end customer. As a result, we will not recognise revenue straight away. We'll recognise it again when the goods are sold to the end customer. So the current accounting treatment, again, is not correct, and we have explained why. Let's now look at the second requirement. It's a question about provisions, and it seems to be two questions. Provision, something to do with sales tax. something to do with income tax. There are two different types of tax, aren't there? So there must be, again, two things we're being asked about. Even before we read the scenario, excuse me, you should be thinking about your knowledge on provisions. So, definition of provision, when they're recognised, what the difference is between a provision and a contingent liability. If you need to, please pause the recording now while you read through the scenario. The scenario is in two parts: the sales tax and the income tax. The position with each is different, isn't it? With the sales tax, what's happening is Ruble has misunderstood the law. It all comes back to this, that sales tax has to be charged to the customer if you have a physical and economic presence. No, in fact, that's what they thought. In fact, the law says it's physical or economic presence. So they should have been adjusting for sales tax, charging it, and they haven't. So they're in big trouble. They're in big trouble. They're going to get a big penalty, presumably because of that. They have a problem. So in respect of the sales tax, there must be a provision. I'll need to demonstrate my knowledge of provisions, legal or constructive obligation to transfer economic benefits as a result of a past event, probable, best estimate, can we make a reliable estimate? All of those phrases would be relevant. The income tax is different. This is the company tax, isn't it? So, actually, as it says here, it sounds as if there's not going to be a problem, or I know it's only Ruble's view, but surely the words that they're using when they say there is little chance of income tax, I think it's probably actually giving us a chance to demonstrate our knowledge, not of provisions, but of contingencies. Remember, contingent liabilities are possible liabilities, or possibly even probable liabilities, where they can't get an estimate of the actual cost. So, all very straightforward basic knowledge. Remember, if you're lacking on the basic knowledge, make sure you use our flashcards to revise all those definitions. Off we go then. So, in my answer, I will of course distinguish again the sales and income tax. Before we get there, here's my knowledge. Provisions, liability of uncertain timing or amount. Legal constructive obligation, past event. Best estimate. Must make a reliable estimate. Those points, very straightforward. Contingent liabilities, possible liability or where the liability cannot be reliably assessed. The point is this: if that knowledge is in your answer, you're going to pass, even if you apply it wrongly. The people who don't get through are the people who don't put down the basic knowledge. They just say, right, here's a view on what I think, so there's no knowledge, and then you can't get the credit. So make sure, however you write it, that knowledge is clear from your answer. With the sales tax, I said it's a probable obligation. So as a result, there will be again a provision. Presumably that will include prior year. It will include penalties. There's some debate about whether it's 7 or 10 years. We can't solve it. We just acknowledge that there's a problem from the scenario. Look at the green point though. That's important, I think, because if we're actually saying, well, this was an error, an accounting error. Is it an accounting error? I think so. It's an accounting error not to adjust for tax, isn't it? That means there's a prior period error in the earlier years, so they might need to restate the comparatives, again do a prior year adjustment. Why? There was an accounting error in earlier years. I think that's quite a good point. As far as the income tax goes, though, it's much more unlikely, isn't it? It's just possible. So remember that when you talk about provisions, we would just look at these green words, we would recognise a provision. But if you talk about contingent liabilities, we don't recognise them, we disclose them. We would disclose the contingent liability in the notes to the financial statements. Let's look now at the last part of this question. The last part, well, would it be helpful to users if you had a single historic exchange rate, fixed? Is it allowed? And then, well, by that stage you're saying you don't know what's going on because it says exchange gains and losses on foreign deposits in OCI. By now you're scratching your head and saying you're not sure what's going on. We'll need to read the scenario, won't we? So I recommend now you pause the recording for a minute while you read the scenario. It's only short, this bit, isn't it? Look at the difference between the green words and the yellow words. The green words are example of foreign transactions. So they've got some foreign bank balances. The yellow words are example of foreign subsidiary. And the point is, the accounting is not the same. They're two completely different topics. They're like being asked about sausages and then bananas. A sausage is not a banana. The green is not the same as the yellow. So even if we're not quite sure what's going on, in the second requirement, we need to explain the rules on foreign transactions and the rules on foreign subsidiaries. I think candidates would have struggled with the first requirement, so they just didn't understand what it means. But what the examiner, I think, was saying was, imagine you just picked an exchange rate and then never changed it. Well, you know that results are affected not only by the performance but also by exchange differences. So you could, I suppose you could isolate the results then in some way. Maybe that's a point. You'd probably end up with some pretty crazy answer. When I was young, very young, I have a feeling that the exchange rate, the Swiss franc from my currency was about 8 and now it's about 1. So, it would just be absolutely odd and silly. So I've had a go at the first part of C, but I wouldn't lose too much at sleep about it. So I've said that if you just fixed a particular rate and never changed it, well, an advantage is that you'd be able to isolate the difference relating to performance. The disadvantage is that I think you'll be very far removed from what the company actually has today if you're using some very, very old exchange rate. So we feel a bit uncertain about that. The second requirement, though, is much more straightforward. What are the rules under IFRS standards? So 2 requirements there. What happens with transactions and what happens with subsidiaries? So this is pure knowledge, and if you don't know it, well, you're not going to do very well. Use our flashcards to revise the basic knowledge. Foreign transactions, that's the bank account. A bank account is monetary, you know this. Every year you retranslate at the closing rate, the exchange rate at the balance sheet day, exchange diffs go to the P&L. So foreign transactions are translated every year. This proposal is don't retranslate. Of course it's not consistent. Foreign subsidiaries though, well, write down all the rules. Assets, liabilities and goodwill translate at the closing rate. Profits and losses, usually they use an average rate, don't they? XR is exchange rate. Exchange differences go to OCI. Not if we didn't write down the yellow words, I think that would be unforgivable. A point that you might not be aware of, but a really good point to know, is that with a foreign sub, the exchange diffs go to OCI, but when, again, you sell the foreign subsidiary, they're then recycled, they move back from OCI to the profit and loss. There's a couple of places in the syllabus where recycling comes in. This is one. Cash flow hedges is another, if you listen to our lecture on cash flow hedge accounting. Back here anyway, clearly, just using a single exchange rate is just ridiculous. It's not what we do in current practice. Now the last requirement, although there has been an article on it, may have got you thinking as well. Would it help people if the exchange differences on the overseas deposits, now what is that? Is that the foreign transaction or the foreign subsidiary? This is the foreign transaction. So, if the exchange rate on those overseas foreign transactions, normally that goes to P&L, could we move it to OCI? We just said, didn't we? Transactions to P&L. Could we use it to OCI? And that's been a debate for years, particularly if you have long-term balances and exchange rates go all over the place. People say, well, perhaps you shouldn't really put the differences in the P&L. We do, because that's the way the rule is. But if they were all in OCI, people say it would reduce volatility. It's not a change that's happening, but I suppose it's one that might happen one day. So there's a current issue being examined, well, sort of current issue, something that's been discussed for many, many years. If you change the exchange diffs on transactions from P&L to OCI, it would reduce volatility. And remember, profit is earnings per share. Earnings per share is profit after tax. If you haven't got those exchange differences, messing things up. And here I was just blue skying at the end. I was saying, well, perhaps do you then move them back to P&L when you shut the account or take the cash out? Don't know. They're just sitting there, aren't they, for a couple of marks if we could actually, say something. That section of the question, there we are, 8 marks. You're going to get half of them, aren't you, for the middle requirement, if you're just saying, well, or nearly half anyway, what the current rules are. That's where you pick up your easy marks.